Gross yield is something that we always look at and always talk about in property investment. When I'm looking at a new property, looking at buying something, looking at a client buying an investment property, the gross yield gives me some basic information, and it's always the first thing I look at. So first of all, what is gross yield? It's the weekly rent times 50 weeks divided by the value of the property, and times 100 to give you a percentage. So if you're just purchasing a property, I would use the purchase price. If you've owned the property for a while, you need to be realistic and put in that real value of what the property actually is. I always work on 50 weeks because normally out of 52 weeks you miss a couple of weeks, so hence the 50. So that basically is what I talked about before. Yeah, 50 weeks just because you miss a couple, and the value of the property, if it's gone up, if you've bought it for 100,000 and it's now worth 300,000, you need to use realistic figures. A normal property that most people buy gives you about a 5% gross yield. Now, I'm not saying that's good at all. That just seems to be typically what a lot of property investors buy. So the standard equation, $300 per week on a $300,000 property. That's how the standard works, and that's 5%. So basically you just take the zeros off the figures, and yeah, and that would be a 5% yield. So the first thing we look at is what does this show? At the moment we're paying maybe 5.5% interest. If you're only getting a gross yield of 5%, that means straight away that the rent is not even going to pay the interest. So that means it's a negative property, and it means that you're going to have to put in money. You're going to have to put in money to pay the extra interest. You're also going to have to put in money to pay rates, insurance, all the other expenses that come up. So with this being under the interest rate, it means you've got a loss straight away. If it's 5 to 6% gross yield, it means it's low cash flow. To make that equation work, you really need great growth. If it's 7 to 8%, it's sort of around break even. That's going to pay you low interest when it's around 5.5%. It's going to pay your rates, it's going to pay your insurance, it's going to pay your other costs. But you still need some good growth to really make that property work and make it work for you. 9–10% or better gross yield means it's going to be good cash flow. It's going to pay for all your expenses and give you a little bit of surplus as well. So what sort of yield is right for you? The answer to that is everyone is different. Everyone has something different that they're trying to get, different aims, different goals. So it's important to find out what is right for you and what you're really trying to achieve. So for example, a 5% to 6% gross yield is quite low, but it might suit a high income earner who's gambling on high growth. So for example, we've got an airline pilot who's bought properties along the river. They are very low gross yield, but he's got extremely high income, and it's a secure income so that he can pay for those and look after them. And what he's hoping is that he's bought them right at the bottom of the market and that they're going to jump up and he's going to get very good capital gain long term. With that as well, a couple of words that I use that's really important. He's got secure income, so he knows he's always going to get a job, and in his case he's actually got income protection insurance or something else to make sure that that income stream is going to be there. 7 to 8% might be your average investor. They've got average cash flow, so they want it to be more or less break even. They don't want to be putting in thousands and thousands and thousands of dollars year after year, so they still require good growth and a reasonable cash flow. 9 to 10% might suit an investor with low cash flow. They're actually wanting to get something out of the property rather than putting it in. And so 9 to 10% will be safe even with interest rates going up. And at the moment it's going to give them some extra cash. If you're looking to own a lot of properties, so you're looking at 5, 10, 15, 20 properties long term, you need to concentrate on high yield. You need properties that are going to pay for themselves. You can't afford to go out and buy 20 properties where they're costing you $10,000 a year each. That's going to take any cash you have, and likelihood you're not going to have that kind of income. So if you want to buy a lot of properties, you really need the high yield, make sure they're paying for themselves and giving yourself a return. One, it's going to help with your cash flow, and two, it's going to look really good from the bank's point of view and to help them lend on more properties. So it keeps the banks happy with income, it pays for itself, and the other thing is interest rates will rise at some point, so you need a buffer, and that's the same for any property investors. You've got to be aware that sooner or later interest will go up. Interest normally averages about 7.5%, so that is an extra cost coming up, and you need to allow for it a little bit.